Is the market about to crash, or is this just another false alarm? Today, we'll be breaking down the shooting star candlestick pattern and what it could mean for your investments. In the world of technical analysis, candlestick patterns are powerful tools that traders use to interpret price action and predict potential market movements. Among the many candlestick formations, the shooting star stands out as a particularly important signal, especially when it comes to identifying potential reversals at the top of an uptrend. But what exactly is a shooting star pattern? How is it formed, and why does it matter so much to traders and investors? Let's dive deep into the anatomy, psychology, and practical implications of the shooting star candlestick. The anatomy of a shooting star. A shooting star is a single candle pattern that typically appears after a sustained upward price movement. Visually, it is easy to recognize due to its distinctive shape. Small real body. The real body of the candle, the area between the open and close prices, is small and is located near the low of the session. Long upper wick, shadow. The upper wick is much longer than the real body, usually at least twice the length of the body. This wick represents the distance between the session's high and the close. Little or no lower wick. The lower wick is either very short or non-existent, indicating that the price did not fall much below the opening price during the session. This unique structure gives the shooting star its name, as it resembles a star falling from the sky with a long trail behind it. The story behind the candle. To truly understand the shooting star, it is important to grasp the story it tells about market psychology during the session in which it forms. Strong opening and upward momentum. The session begins with bullish enthusiasm. Buyers are in control, pushing the price higher and continuing the prevailing uptrend. A surge to new highs. At some point during the session, the buying pressure intensifies and the price surges to a new high. This is the tail of the shooting star, the long upper wick. Sellers step in. However, as the price reaches these new highs, sellers begin to take profits or short sellers enter the market. The selling pressure increases, and the price is pushed back down toward the session's opening level. Weak close. By the end of the session, the price closes near its low, forming a small real body at the bottom of the candle. The long upper wick shows that the bulls tried to push the price up, but the bears ultimately won the battle. This sequence of events encapsulates a dramatic shift in sentiment, from bullish optimism to bearish caution, all within a single trading session. Why the shooting star matters. The shooting star is significant because it often marks a potential turning point in the market. When it appears at the top of an uptrend, it serves as a warning that the bullish momentum may be fading. The long upper wick is a sign that buyers were unable to sustain higher prices, and the close near the session's low suggests that sellers are gaining strength. For traders, the shooting star is a classic reversal signal. It doesn't guarantee that the trend will reverse, but it does indicate that the risk of a pullback or correction has increased. As such, it prompts traders to be cautious about entering new long positions and to consider tightening stop losses or taking profits on existing ones. The psychology of the shooting star. At its core, the shooting star pattern is a reflection of market psychology. It captures a moment when optimism gives way to doubt and when the balance of power shifts from buyers to sellers. Here's how the psychology plays out. Euphoria at the top. After a strong uptrend, many traders and investors are feeling confident. The market is moving higher, and there's a sense that the rally will continue. Overextension. As prices surge to new highs, some traders become overconfident, buying at elevated levels in the hope of further gains. Reality check. Suddenly, selling pressure emerges. This could be due to profit-taking negative news or simply a lack of new buyers willing to pay higher prices. Shift in sentiment. The rapid reversal from the session S high to a weak close shakes the confidence of bulls and emboldens bears. The long upper wick is a visual representation of this failed attempt to move higher. This psychological shift is what makes the shooting star such a powerful pattern. It is not just about the price action. It asks about the emotions and decisions of market participants. Identifying a shooting star. Key criteria. To accurately identify a shooting star, traders look for the following criteria. Location. The pattern should appear after a recognizable uptrend. If it forms in the middle of a sideways market or at the bottom of a downtrend, it loses its significance. Candle structure. The upper wick should be at least twice the length of the real body. The real body should be small and near the session's low with little or no lower wick. Volume, optional. Some traders look for increased volume during the formation of the shooting star, as this can add weight to the reversal signal. Shooting star versus other patterns. It's important not to confuse the shooting star with similar candlestick patterns. For example, inverted hammer. This pattern looks identical to the shooting star, but appears at the bottom of a downtrend. It signals a potential bullish reversal, not a bearish one. Gravestone doji. This is another bearish reversal pattern with a long upper wick and little or no real body, but the open and close are almost identical. Understanding these distinctions helps traders avoid misinterpreting signals using the shooting star in trading. While the shooting star is a valuable warning sign, it should not be used in isolation. Savvy traders look for confirmation before acting on the signal. Confirmation might come in the form of a bearish candle on the following session, such as a strong red candle closing below the shooting star's real body, a break below a key support level, bearish signals from other technical indicators like RSI, MACD, or moving averages. By waiting for confirmation, traders reduce the risk of acting on a false signal. Real-world examples. Throughout history, shooting star patterns have appeared at the tops of major market rallies, often preceding significant corrections. For example, during the dot-com bubble in 2000 and the cryptocurrency boom in 2017, shooting star patterns were visible on the charts before sharp declines. Bubble burst or false alarm? The importance of confirmation and context in interpreting the shooting star pattern. The appearance of a shooting star candlestick at the top of an uptrend can send a jolt of anxiety through traders and investors. Its dramatic shape, a small real body near the session, S low, and a long upper wick, suggests that bullish momentum may be faltering and that sellers are starting to take control. But does this mean the bubble has burst? Or is it just a temporary pause before the market resumes its climb? The answer is rarely straightforward. In technical analysis, context and confirmation are everything. Let's explore why a shooting star is a warning, not a prophecy, and how to distinguish between a genuine reversal and a false alarm. The shooting star, a red flag, not a red light. First, it's crucial to understand that a shooting star is a potential reversal signal, not a guarantee. It's a red flag that says, pay attention, something might be changing. But markets are complex, and no single candlestick pattern can predict the future with certainty. The shooting star tells us that sellers have pushed back against buyers, but it doesn't tell us whether this shift will continue or quickly fade. The role of confirmation. This is where confirmation comes in. Confirmation means looking for additional evidence that supports the initial signal. In the case of a shooting star, confirmation typically comes from the price action in the candles that follow. Here's how traders look for confirmation. Bearish follow-through. If the next candle after the shooting star is a strong bearish candle, closing below the shooting star's real body, it suggests that sellers are indeed taking control. This increases the likelihood of a trend reversal. Break of support. If the price breaks below a key support level or trend line after the shooting star, it's another sign that the uptrend may be ending. Volume spike. Higher than average trading volume during or after the shooting star can add weight to the signal, indicating that the shift in sentiment is backed by significant market participation. Without confirmation, the shooting star is just a warning, not a call to action. False alarms. When the market shrugs it off. Markets are full of noise and false signals. Sometimes a shooting star appears, but the market quickly recovers and continues higher. This can happen for several reasons. Strong underlying trend. If the broader trend is very strong, a single bearish candlestick may not be enough to reverse it. Buyers may see the dip as a buying opportunity, quickly pushing prices back up. Lack of follow-through. If the next few candles are indecisive or bullish, it suggests that sellers were unable to maintain control. The shooting star in this case was just a blip in an ongoing uptrend. External factors. News events, economic data, or central bank actions can quickly change market sentiment, overriding technical signals. This is why experienced traders never act on a shooting star alone. They wait to see if the market confirms the signal or invalidates it. The importance of context. Context is everything in technical analysis. The same pattern can have very different implications depending on where and when it appears. Here are some key contextual factors to consider. Location in the trend. A shooting star at the top of a long, overextended rally is more significant than one that appears after a short, modest uptrend. Market environment. In volatile or news-driven markets, candlestick patterns can be less reliable. In calm, trending markets, they may carry more weight. Support and resistance levels. If a shooting star forms near a major resistance level, it's more likely to signal a reversal. If it forms in the middle of a trading range, it may be less meaningful. Volume. Patterns that form on high volume are generally more significant than those on low volume. Combining candlestick patterns with other indicators. No technical indicator or pattern should be used in isolation. The best traders use a confluence of signals to make decisions. Here are some tools and indicators that can be combined with the shooting star for a more robust analysis. Moving averages. If the shooting star forms near a key moving average, like the 50-day or 200-day, and the price breaks below it, the reversal signal is stronger. Relative Strength Index, RSI. An overbought RSI reading, typically above 70 at the time of the shooting, star adds to the case for a reversal. MACD, Moving Average Convergence Divergence. A bearish crossover in the MACD after a shooting star can provide additional confirmation. Fibonacci retracement levels. If the shooting star forms near a key Fibonacci level, it may indicate a significant resistance point. By combining these tools, traders can filter out false signals and increase their chances of making successful trades. Real-world examples: bubble burst or false alarm. Let Boas look at some real-world scenarios to illustrate the difference between a genuine bubble burst and a false alarm. .com bubble 2000. In the months leading up to the crash, shooting star patterns appeared on the charts of many tech stocks. In several cases, these were followed by strong bearish candles, breaks of key support levels, and confirmation from other indicators. The result was a major reversal in the bursting of the bubble. Bitcoin rally 2017. As Bitcoin approached $20,000, shooting star patterns appeared on the daily and weekly charts. In this case, the patterns were followed by heavy selling, high volume, and confirmation from momentum indicators. The market reversed sharply, marking the end of the bull run. False alarms. There are also countless examples where a shooting star appeared, but the market quickly recovered. For instance, during strong bull markets, minor pullbacks often produce shooting star patterns that are quickly invalidated as buyers step back in. Risk management, protecting yourself from false signals. Because no pattern is foolproof, risk management is essential. Here are some best practices. Wait for confirmation. Don't act on the shooting star alone. Wait for additional bearish signals before entering a trade. Use stop-loss orders. Protect yourself from unexpected reversals by setting stop-loss orders at logical levels. Position. Sizing. Don't risk too much on a single trade. Use proper position sizing to manage your overall risk. Stay objective. Don't let emotions drive your decisions. Stick to your trading plan and rules. The bottom line: a shooting star is a valuable tool in a trader's arsenal, but it's not a crystal ball. It's a warning sign that the market may be about to change direction, but it's not a guarantee that the bubble has burst. By looking for confirmation, considering the broader context, and combining candlestick patterns with other indicators, traders can make more informed decisions and avoid costly mistakes. In the end, the market is a complex system influenced by countless factors. Technical patterns like the shooting star provide clues, but it's up to the trader to interpret those clues wisely. Remember, context is key, confirmation is crucial, and risk management is non-negotiable. Only by respecting these principles can you navigate the fine line between bubble burst and false alarm.